An alert has been issued from Hokkaido to Wakayama Prefecture for a tsunami of up to 3 meters at the most along the Pacific coast of Japan. For those living in these areas, please evacuate immediately to a safe place such as higher grounds.
That was Japan's Chief Cabinet Secretary Yoshimasa Hayashi as Japan has issued tsunami warnings for areas including Tokyo Bay. You're seeing live pictures from Japan now, with the tsunami coming after a series of earthquakes near Russia this morning. Hello, I'm Paul Allen, live from Sydney, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Also today, US negotiators wrap up trade talks with China and Sweden, saying there's no firm agreement to extend their tariff truce, with President Trump set to make the final call. As other nations rush to seal deals ahead of Friday's deadline, we'll speak to someone with a direct experience of negotiating with the Trump White House, former Canadian Trade Minister Mary Ng. And the Fed expected to keep rates on hold. This is despite Trump's pressure for a cut. Investors, though, will be watching for any dissenting votes. We'll assess the bond market impact with Goldman Sachs Asset Management's Salman Niaz. Also, insights on the rates and tariff risks for commercial real estate. We'll be joined by JLL Asia Pacific's Pamela Ambler. We have Indonesia, Taiwan and Japan, as well as the US, all issuing a warning for tsunami after an 8.7 magnitude earthquake hit off the east coast of Russia earlier today. Bloomberg's John Herskovits joins us now from Tokyo with more. So, John, tell us, what's the latest?
Sure. According to Japan's meteorological agency, the tsunami has started to hit parts of Japan, beginning in Hokkaido, the main northern island, and the Pacific coast has been affected. The warning has gone for most of the Pacific coast of up to 3 meters in height for the tsunami. What we've seen so far is a tsunami of about 30 centimeters, 1 foot, to 40 centimeters. It's gone down large portions of the Tohoku region. This is the northeast region. This is the region that was hit by the devastating earthquake, tsunami, and nuclear disaster in 2011 that left about 20,000 people dead or missing. This region also has really strong fortifications, seawalls up and down the coast to prevent against tsunamis. So far, that's the area that's been affected. It's still making its way down the Japan's Pacific coast. We haven't had any reports of significant damage or injuries, and we're trying to keep an eye on things as it moves closer to the Tokyo region and then moves further towards regions such as Nagoya and Osaka regions, the Pacific coastal areas around those.
Yeah, Japan's terrible experience in the past explaining this abundance of caution. What potential impact could we see on Japan?
If it continues along this way and the tsunami stays under 50 centimeters, Japan should hopefully be able to dodge a bullet on this. But, you know, with the 2011 tsunami, this caused tens of billions of dollars in damage. The loss in life was extraordinary. We had the nuclear disaster at the Fukushima plant, which is still a major site of contamination. So the worries are huge, but as the way things are playing out now, there are concerns, but they're not of the magnitude of a major tsunami that Japan has seen just about 14 years ago or so.
Yeah, you and I both covered the 2011 tsunami that hit Japan. What lessons were learned from that? How's Japan's response so far measuring up? Because I remember in the case of Fukushima, it was later revealed that the backup generators for those reactors were in the basement, perhaps not the brightest place to put them. What other changes were made?
We've seen some of the changes being implemented quickly with nuclear power plants, some of them shutting down operations, suspending operations. We've seen these seawalls that have gone up, the safety concerns of what is above and below sea level when it comes to these backup facilities. And the caution that is there is abundant on the coast. And if you're in the area, like the Tohoku region, if you're just a person, you'll see signs on the coast about how far you are above sea level, 3 meters, 5 meters, so you know where to go if you need to evacuate, where the higher ground is and where you are. So it's gone in from the major industrial construction for power plants, infrastructure, to just basic signs to let people know this is where you are, and if you need to get to a higher area, go to a place where the sea level is higher. So lots of things, and you have a warning system that's in place that people hear it on TV, you hear it in the region, and also with 2011, fire brigades were on the streets warning people to get to higher grounds. Often these firemen lost their lives trying to get people to get out of the region as they went around their various areas, warning people about what was coming.
Well, it's been approximately 4 hours now since that first earthquake. Can you tell us what we've seen and what we might expect in terms of other aftershocks, and how long it's going to be before the all clear gets given?
I don't know how. In the all clear, maybe sometime. The aftershocks seem to be quite large. Japan's broadcaster, national public broadcaster NHK, showed some footage from Russia where the footage indicated damage to structures, a tsunami in some places, and given the magnitude of the earthquake, something of this size produces a lot of aftershocks for several days. So we're not in the clear yet. We can expect probably some more seismic activity, and I'm not sure when the tsunami warning and advisories will be lifted, given the threat of aftershocks from this quake.
All right, Bloomberg East Asia Government Editor John Herskovitz there. Thanks for updating us as we do continue to watch the progress of those tsunami waves. No serious problems so far, but let's take a look at how Japanese stocks are reacting. Taking it all in stride at the moment, the companies you're seeing on the left there all operate nuclear power plants. At the moment, they're in mostly positive territory. Tokyo Electric Power up by about 1.25%. And as John mentioned, there are a number of resiliency measures have been put in place since that absolutely catastrophic tsunami back in 2011. Staff, however, have been evacuated from Fukushima plants, and generation in a number of plants has been halted. Kansai Electric has seen its output halted, as has Onagawa Nuclear Plant as well in Tohoku, which was one of those areas also badly hit back in 2011. All right, still to come, former Canadian Trade Minister Mary Ing's going to join us with her insights on the best outcome for Canada. Getting some breaking news out of India. We've said that Reliance is said to be seeking to float 5% in a JIO IPO to raise $6 billion. So proposing to sell just 5% of its Jio telecommunications unit in a potential listing that could raise up to $6 billion. This is according to people familiar with the matter. That IPO could take place as soon as next year, according to these sources, that make it possibly India's biggest ever. Even a float of just 5% at the current valuation would raise more than the Chinese battery giant CATL and their offering in Hong Kong, which was the largest listing globally this year. So that breaking news on Bloomberg. Reliance said to seek a 5% float in Jio, which would potentially raise up to $6 billion. Well, U.S. Treasury Secretary Scott Bessent says the U.S. and China will continue talks over maintaining a tariff truce before it expires in 2 weeks, and the President Donald Trump will make the final call on any extension.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
That's Treasury Secretary Scott Bessent speaking after 2 days of meetings with Chinese officials in Stockholm. So for more on this, let's get to our China correspondent, Min Min Lo. So Min Min, some progress. What's going to happen next?
Yeah, so President Trump certainly keeping markets waiting as to whether or not that trade truce is going to happen after a lot of signals from Scott Bessent, from Howard Lutnick, that the trade truce could be extended. But for now, the mood music appears to be quite positive. Both sides, U.S. and China, both saying that the talks had been constructive and productive and candid and wide-ranging as well. Of course, a very big part of the discussion was on rare earths. Jamieson Greer, the trade representative, saying he never wants to talk about rare earths ever again. To him, it is case closed, and he says this is the largest concession that China has given to the U.S. They have pledged to keep rare earths flowing. When it comes to the sectoral tariffs, the Section 232 investigations that the U.S. is conducting, China wanted some updates on that, but the U.S. says that the announcements will come. There will be no exemptions for any countries. Of course, the Ukraine war has been in focus as well, given President Trump had imposed that ultimatum on Putin. And Scott Bessent said he warned his Chinese counterpart about potential secondary sanctions on China for purchasing those sanctioned oil, potentially as high as 100%. And this is where things got a little bit intractable, because cutting down China's oil purchases is going to be quite disruptive for the Chinese economy, given that Russia is China's largest source of crude oil. Of course, this is something that, Scott Bessent has left open. He said that the Chinese side expressed their concerns, saying that they will continue to protect their energy sovereignty. It's coming against this backdrop of China's energy imports from the U.S. falling to zero in the month of June because of trade tensions escalating. So some technical details, according to Scott Bessent, that still needs to be worked out between the two sides.
All right, Bloomberg's China correspondent Min Min Lo there. Sticking with trade, President Trump says India may face tariffs of 20 to 25%. That'll be slightly lower than the 26% rate he announced for India back in April. Trump notes a levy still has not been finalised, and that's despite Indian officials expressing optimism on reaching a deal.
India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and we just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
Meanwhile, South Korean officials met with U.S. Commerce Secretary Howard Lutnick in Washington, this in a last-ditch effort to avert 25% tariffs. The Wall Street Journal reports that Lutnick urged Korean officials to bring it all when making their final trade offer, saying Trump still needs to be convinced as to why a new deal with Seoul is necessary, given recent agreements with the EU, Japan and the UK. Well, Canadian Prime Minister Mark Carney says his government's still in trade talks with the US, and that's despite recent comments from President Trump that suggested a deal was not a priority. Joining us now to discuss this is someone with direct experience in dealing with the Trump administration, and that is former Canadian Trade Minister Mary Ang. Mary, thanks so much for joining us today. The Prime Minister saying that US-Canada trade talks are in an intense phase. As someone with first-hand experience of this, what does he mean? What's it like? What will be happening right now?
Well, my former colleagues, the current trade minister, as well as the Canadian team, are absolutely continuing to do the work that they need to do with the United States. Canada is the United States' biggest customer, and the United States is Canada's largest trading partner. And I think it's really important to do everything possible by the Canadian government to try to get to an economic and security deal with the United States. It's really important for Canadians. But I would also say that Prime Minister Carney has also been really clear that whatever the deal is going to look like has got to work for Canadians, and we do believe that we can actually do something that would work for the Canadians and the Americans. So this work is intensive, as the Prime Minister has said, and the officials have been at the table. They've been at the table for months, and that work will just need to continue.
Your Prime Minister Carney says that he won't be signing a pact unless it's, quote, a good deal for Canada. How much leverage does he really have, though? He's not in the same position, for example, as China is.
Well, if you take a look at Canada as the customer to the United States, I mean, we do about $1 trillion worth of trade, and Canada buys more from the United States than Japan, China, the United Kingdom combined, and so this trade relationship is an important one. I think one of the things that has been, I think, a constructive approach is that the USMCA, or CUSMA, which was what we call it in Canada, was a deal negotiated by President Trump the last time he was in office. And right now, those goods that are CUSMA or USMCA compliant are not getting tariff. And that's about 40% of the trade for Canada. But areas, sectors like steel and aluminum and copper are facing significant tariffs. So it's really important that the Canadian team does everything possible to ensure that we get an arrangement with the United States that would be satisfactory to Canadians. Canadians expect that of their government, and no doubt that would certainly be the way I would have approached it, and would approach it today.
Well, if that doesn't happen, what's the plan? Is there anything Canada can do to either retaliate or force a better deal?
Well, right now I'm in Singapore. I'm back in Singapore, and as the trade minister for Canada, I spent a lot of time what I would call building the foundation that allows Canada to diversify. The Prime Minister has been really clear. We need to reduce our reliance on the United States. We export 75% of our exports to the United States, and that is just an over-reliance on the United States. So Canadians, I think, are completely there with this Prime Minister. So let's remove the interprovincial trade barriers that exist in Canada so that we are more productive in Canada. Let's double down on the trade relationships that we have with many parts of the world, whether it be the Europeans or whether it's right here in the region, in the Indo-Pacific. We're part of the CPTPP. Singapore and countries like Australia, New Zealand, Japan, and others are a part of this really important pact. We are at the table negotiating with the ASEAN. One of the last negotiations I did was with Indonesia. These are really important markets, and I think for Canada, it's really important to look to do business with other trading partners where the Canadian businesses once upon a time may not have had the urgency to do so. I think really are seeing that urgency today.
Yeah, that's a point that the former Prime Minister Stephen Harper is making as well. You know, the need to diversify trading partners also. So with that in mind, can you give us a sense of what Canada's relationship with China is at the moment in terms of trade? And, one of China's goals is to eventually ascend to the CPTPP as well. Could you see that happening?
Well, Canada was the chair of CPTPP, and I, as the trade minister, chaired it last year. We have been able to bring into the CPTPP countries like the United Kingdom. Costa Rica is in the process, as I understand right now. I know that we are having conversations with the European Union. The CPTPP makes, as a collection of countries, makes decisions on accession on a consensus basis. So they're going to have to decide. The members of the CPTPP are going to have to decide who will be the next countries that will come into that agreement. The agreement had always envisaged to be an open agreement, but the other things that we have talked about over the years is that it's a high standard agreement, really strong provisions on the environment and on labor, really an agreement that actually sees opportunities for small and medium-sized businesses to get into global value chains. That's the kind of work, and I think that's what's really important to many of the members. And that work, I suspect, this year under Australia's leadership, they are well underway in doing.
Yeah, and Australia is one of those countries that has seen its relationship with China improve dramatically from where it was a few years ago. And I just want to return to the earlier part of my previous question. How's Canada's relationship with China right now? How would you characterize it?
Well, I think that I know that certainly, one of the last things I was able to do as minister at one of the multilaterals at APEC, I did have a meeting with my Chinese counterpart, and I think that those meetings are continue at the foreign minister level, the trade minister level, and I think that we have to find a way to work with the second largest economy in the world. But through Canada's Indo-Pacific strategy, we've articulated a way in which we can work with China. One where we would have a challenging function for those things that are really important to Canadians, compete where we can compete, coexist, but also cooperate. I mean, in the areas of the environment and climate change, you saw Canada and China come together during a biodiversity conference that was China's lead. China couldn't do it. We hosted it in Montreal and found a way to be able to cooperate and do work together. But I think values that are important to Canadian, whether it's human rights or whether it is rules-based trade, are just values that that are important to Canadians, and therefore the government is going to have to navigate that through in response to the will of the Canadian people.
Trade deals typically get carved out over a period of years. What we're seeing here is a whole series of trade deals getting done in a space of a few weeks. I mean, as a former negotiator, when you look at these sorts of timelines, how revolutionary are these deals really? Or are they just sort of nibbling around the margins and really about optics?
Well, what I'm hearing from businesses certainly and people is just the uncertain nature of the approach that the American administration is taking to these various tariff applications and the way in which these negotiations are taking place. You're absolutely right. They do take time to trade deals do take time to negotiate. In Canada's case, it was under President Trump that we negotiated or renegotiated what was NAFTA at the time to what is USMCA or CUSMA that they call in Canada today, and yet we are facing down tariffs. So one has to ask yourself, I mean, how reliable are these deals even when they do come to fruition? And therefore, what do you do as a country? So in Canada's case, as I said, it is really making sure that we're strong as a country, we're competitive as a country, and that we look to the trade agreements that Canada has spent years at developing with partners who are reliable and who will adhere to what it is that we've agreed to at the negotiating table. And today, Canada has access to 65% of the global economy through the free trade agreements we have today. And the work that is ahead is really ensuring that Canadian businesses and investors go into those markets where we have these great trade agreements and do the commercial and investment deals that I think are there. It will be different. It will be tough to do, but I do think that is something that is doable for sure for Canadians and for our trading partners.
Mary, just before we let you go, I'm just curious, as while this is all getting worked out with the United States and these tariffs are in place, are there any signs of weakness or distress in the Canadian economy?
The uncertainty is what is causing the anxiety. Businesses want to know how to plan. Investors want an environment that they understand so that they can make investments. So I do think that we are seeing a chill of both of those, and so the government doing all of its level best to try to get to some kind of agreement, I think is going to be a positive thing, because our economy and our businesses and our investors really are looking to that stability for as long as that stability can last.
All right, Mary Ng, former Canadian Trade Minister, thank you so much for joining us as we await progress in the US-Canada deal. Still to come, Goldman Sachs Asset Management's Salman Niaz is going to join us with his expectations for the upcoming Fed decision and how geopolitical tensions are shaping fixed income flows in the Asia-Pacific. Stay with us for that conversation. This is Bloomberg. Welcome back. You are watching Inside. Let's take a look at what's happening in the Treasury space. We did see yields slipping across the curve ahead of the Fed meeting this week. The 10-year saw its biggest one-day rally in almost 2 months. The yield dipping to about 4.32%, and that's where it's sticking at the moment. But we also saw yields at the longer end of the curve slipping. Strong demand as well for the 7-year auction, selling $44 billion worth of those notes. And in terms of the Fed, well, we're not really expecting anything to happen this week. That'll be 5 meetings in a row where the Fed stands still. September could be a live one. Of course, in the commentary, we're going to be watching for any dissenting voices, although one might think that a little bit of disagreement would probably be normal as a policy pivot gets closer. Joining us now to talk more about this is Salman Niaz, Head of Global Fixed Income for APAC, ex-Japan at Goldman Sachs Asset Management. Salman, thanks so much for joining us today. Of course, as I mentioned there, the Fed meeting coming up. We're not expecting any change, but what are you expecting to hear, though, in terms of some of the commentary afterwards in the press conference?
Morning, Paul. Thank you for having me. It's a pleasure to be with you. So I think, as you said, the upcoming Fed meeting this week is not a live meeting, but market watchers and investors are really looking to the dissenters. There's a possibility that we may have 2 dissenters on this upcoming meeting, and it would be the first time in over 2 decades that would be the case. So it's an important one to watch. Our thinking remains that there isn't enough information for the Fed to be acting in the near term. September, as you highlighted, is a live meeting in our view. But a lot of price and job data still needs to come through, and it gives Fed the optionality to take a little bit of time as they decide their next action.
Yeah, well, some of that price and job data is going to come through at a timely moment as well, where you get a jobs report on Friday morning in the US. What sort of resiliency are you expecting to see in the US labor market?
I mean, the JOLTS data that came out earlier this week suggested a little bit of weakness under the hood, if you will. The market's kind of penciling in 100 to 110,000 kind of job print from the NFPs on Friday. If you recall, the last NFP print surprised to the upside, so resilience is the right word to continue to use. We're watching this very closely. I think that's kind of the key driver of what the market participants and investors are looking for to have a better read on the Fed's forward action. The U.S. economy continues to be quite resilient. And if we look at the previous episode of tariffs, it typically takes 3 to 5 months for the tariffs to have implications into price levels and CPI. So we think there's more time before that picture becomes clearer. So really the key thing to the point that you raise is to focus on the jobs data, which in addition to the one this week, we'll get a couple more before the September Fed meeting.
Yeah, the September Fed meeting is now the one that's attracting attention. And, of course, after what's expected to be no change this Friday, that's one of just 3 meetings left. Now, the market is pricing in 2 cuts still for 2025, but that does suggest we're going to get a lot of cuts towards the end of the year. How realistic do you think that expectation is?
I think it is very data dependent. Unfortunately, that's been sort of the situation we've been in for the last few meetings as well. So it can be unsettling for some market watchers, but I think that's the right course of action. The economy continues to be resilient. The weakening of the dollar has done some of the financial conditions easing work for the Fed. The rally in risk assets has done some of the work in terms of easing financial conditions. So, I think the one of the more important points to make is that the Fed has significant capacity to come in to support monetary conditions and the economy as and when that's needed. And given the jobs data, the price data, they have more time to take that action.
Yeah, you mentioned the word support, and that's an important one to remember, because if we step back, you'd have to ask yourself, why would a central bank cut rates if the economy's looking strong? In your view, is the US economy in need of support right now, and are rates pretty much where they need to be with that in mind?
I mean, certainly the current rate picture is a tightening bias in the funding market, so there is some room to neutral from the current levels, which is what informs our thinking also 1 to 2 cuts this year and potentially getting down to mid-threes from a neutral bias. So I think that's part of the thinking of expecting some normalization, if you will, of the monetary policy in the U.S. But I think your point is a very valid one, which is that the resilience in the U.S. economy remains quite strong. And, you know, time, as I've repeatedly said, time, I think, is on the Fed side. And market participants would like to have significantly higher level of clarity. But, you know, I think in many ways, you know, data is going to really drive how the Fed acts here. So, I mean, you highlighted we're expecting potentially 2 cuts before the end of the year. I would say there's potentially a bias for less than 2 cuts to the extent that the jobs data continues to come in stronger.
Well, we've seen yields slipping pretty much across the curve heading into this week's meeting of the Fed. What is that market pricing telling you?
I think it's small moves, to be honest. I don't think you can read very much into these moves. You know, you've got currency moves also sort of happening, but, you know, from a probability of what's priced into the forwards and the cuts that are expected, there's not a material shift, I would say, that's happening. As I mentioned, I think the market's kind of looking very closely data point by data point, if you will, and making small adjustments to its thinking. But in terms of a step function, I think we'll get a lot more clarity over the next 60 to 75 days as we get more jobs data.
Yeah, and if we don't get easing at the pace that the market is expecting, what sort of impact are you expecting to see on fixed income assets?
Yeah, I think that's a great question. It has sort of several implications. You know, to the extent that the market comes to a view that the U.S. rates need to stay higher, or the neutral rate is significantly higher than where the market's thinking at the moment, that has implications potentially for exchange rates. More likely than not, it will lead to dollars, you know, dollar being a little bit stronger. You know, it also has the potential for dollar assets to retain a higher yielding bias, if you will. I think as you look sort of beyond the United States, away from the FX markets, the direction of travel seems pretty clear. I mean, ECB is towards the end of its cycle. They paused. You know, BOE is in an easing type of mindset. BOJ is in a hiking mindset. Most of emerging market central banks are in the easing mindset because they have still reasonably high real rates. So I don't think that picture changes very materially. Potentially, depending on how the dollar and exchange rates react, some of the emerging market central banks may take a bit of a pause to try to manage and look through some of the currency volatility that may come on the other side of it. So it potentially creates a little bit of uncertainty around some of the emerging market central bank action to some extent. But I would say, by and large, the direction of travel for the global economy, which is, you know, a Titanic in the ocean, in motion, if you will, the direction doesn't change so quickly. It takes it takes longer for the direction to change. And you know, the backdrop for us as investors has shifted quite meaningfully. I mean, a lot of the uncertainty around the framework of the way we're investing, which we saw in the first and second quarters around tariffs, you know, potentially significantly faster slowdown in the U.S. economy, and some geopolitics, you know, a big part of that framework has now become clearer, while the forward path still remains a little bit uncertain around how how much of a slowdown or a price impact you might see. It's become clearer that the general guardrails or the goalposts of the tariff picture has become clearer, if you will. It's become significantly clearer that the U.S. economy is very unlikely to go into a recession this year. We will probably see a little bit more slowdown, but it'll continue to have a growth bias. The tax bill is also now well known. The markets are going to continue to digest how that has an implication both for deficit, but also how much of a growth picture the U.S. economy is going to continue to portray to balance that deficit versus growth. So, as we look forward, I would say some of the bigger risk questions have been answered. There remains sort of some uncertainty around the path of travel, and the data that comes out becomes significantly more important in terms of the direction of travel and how markets will react.
Can you tell us a little bit more about some of the trends that you're seeing in terms of fixed income demand in the area that you look after, Asia Pacific, ex-Japan?
Certainly. I think broadly, I would say both in working with our clients in the region and also working with our global clients that are investing in the region, there's a few themes or trends that are continuing to be sort of the tailwinds to fixed income. One is nominal yields are attractive, so across portfolio allocations and taking exposure, the attraction for fixed income remains high. There's obviously tactical aspects to that allocation that clients think about, and given the growth-oriented global macroeconomic picture and the resilience of generally global economy by and large, and the extension of the business cycle is leading a lot of our investors from the region to think about some of the asset classes within fixed income that have been lagging or may have more dispersion and more opportunities for selection that become attractive. For our global investors that are investing in the region and for ourselves managing that capital for our clients, I would say we continue to find opportunities in the region that are both have a diversifying effect to global portfolios and have some opportunity to add excess return. So one of the markets in the region that has gotten a lot of attention and continues to get more attention is around high yield, where the default cycle is behind us. Beyond that, I would say the certain local rate markets are quite attractive and additive to the overall return profile of global portfolios. The sovereign and the corporate market, by and large, I would say is very healthy in the region. Investors continue to view that positively. There isn't a whole lot of mispricing left in that market, I would say. So it really boils down to investors taking a view at it as a part of their overall global asset allocation, and it continues to find its place, if you will, in the portfolio.
All right, Salman, Niaz, heads of global fixed income for APAC, ex-Japan at Goldman Sachs Asset Management. Thanks so much for joining us today with your insights. Just want to update you on the latest of this tsunami warning. There is now a tsunami warning in effect for California. We've heard from Gavin Newsom on the platform X saying that tsunami warning now in effect along parts of California's north coast from Cape Mendocino all the way up to the Oregon border. So Gavin Newsom urging people to stay alert, follow instructions from emergency personnel, and this, of course, following that very powerful above magnitude 8 earthquake in northeastern Russia earlier today. That was a few hours ago. Also, an update from Japan as well. We're hearing from Nissan, the car manufacturer. Nissan is now looking to evacuate one of its plants near Yokohama. It's a Palmer plant. This is on Tokyo Bay, so Nissan evacuating that Palmer plant just south of Yokohama on the tsunami warning, although at this stage not seeing any evidence of powerful waves hitting the coast in Japan, but need to remain vigilant still in place. Still to come, we're going to speak to JLL about the resilience of Asia's commercial real estate investment market despite all the tariff uncertainty. This is Bloomberg. Asia's commercial property market appears to be showing resilience despite the uncertainty surrounding US trade policy, but investors are now underwriting slower growth scenarios. Global commercial property and management company JLL's just released data for Asia's real estate investment transactions, and it believes sectors including retail, industrial and logistics, energy and infrastructure are facing the most geopolitical risk over the next 5 years. Let's get some more insight now from Pamela Ambler, head of APAC Investor Intelligence at JLL. Pamela, thanks so much for joining us today. I just want to start by talking about some of the trends in that report. How much uncertainty overall is this tariff situation having an impact on commercial real estate?
Well, Paul, based off of the transaction volumes that we've seen for Q2 and also accounting for first half of the year, investment volumes are up by roughly 17%. And so we would likely say that the impact has not been significant in terms of investment appetite. Now, when it comes to the type of investments that investors are looking at doing, they're certainly more discerning. They're focusing a lot more on the tenant creditworthiness. They're looking at exposure where tenants are more having industries domestically dominated rather than having international exposures. Of course, based off of what we're seeing in terms of the asset classes, office is less impacted than, say, logistics and industrials as part of the supply chain discussion. When it comes to office, though, we still are looking very closely at the fact that corporate earnings might be weakening than previously expected given tariff headwinds. But for the most part, across Asia Pacific, we've seen appetite really strong against most of the major markets.
Yeah, and some markets have been performing particularly strongly. Your report notes South Korea, Japan as well. Can you talk to us a little about what's unique about those two markets?
Yeah, Korea has really seen a surge when it comes to foreign investors coming into this market. A lot of it is seeing the, first of all, strongest office market in Seoul, Korea. That's a product of supply and demand dynamics. It's also seeing the strong demand and net absorption when it comes to office demand here. But when it comes to investors looking at dislocations and opportunities, the logistics and industrial warehousing space has had an oversupply after the last few quarters where there has been more work done around the leasing, absorption area. Logistics now is attracting foreign investors. And from a financing standpoint, because the cost of debt has been coming and moving lower, that's also creating more interesting opportunities. Another fact that we're seeing really started happening around the end of last year, towards the beginning of this year, is a surge in foreign groups looking at gaining exposure to the living sector. What do we mean by the living sector? We're talking about multifamily, co-living, senior living. There is a confluence of factors that's impacting the market here. There is a traditional Chongse system, which essentially is a lump sum deposit that people have to put down to rent housing. Well, that doesn't work anymore with the younger generation not wanting to see their money tied up per se in real estate, and having some of the local media reporting on Chongse fraud. And so what we're seeing is multifamily now as an offering. More of the Western adaptation is beginning to take shape here, and a lot of partnerships being formed between foreign investors and local operators.
Yeah, so some strength and some changes in South Korea and Japan you mentioned as well. But on the other side of the coin, we've got Singapore office commercial real estate starting to fall out of favour. Why is that?
I wouldn't necessarily say it's falling out of favor. It's because of the dynamics of the other markets changing. So for Australia, well, Japan, as we have mentioned, it's very strong, and it continues to be strong because of the currency weakness, because of the BOJ low policy rates, accretive yields across all sectors. But for Australia, which is also attracting investors, it's because of the pricing dislocation that we've seen. We're going through a new pricing discovery disparity. And when we are looking at the bids that are coming into the office logistics space, there is a larger bid-ask spread. But when it comes to Singapore, back to your question about why there has less investments, the pricing has remained very stable. So when there are opportunities to invest in cheaper markets, that's where capital is being drawn towards.
At the start, we were talking about some of those sectors that are facing particular challenges, retail, industrial, logistics, energy, infrastructure. But on the other side, there are some sectors that are performing perhaps surprisingly well.
Well, retail actually has seen a large amount of interest come back because it has been out of favor for so many years. Even before the pandemic, retail has not been a favorite sector of investors. There has been less development and new stock in the pipeline, and now we're beginning to see consumer spending, for the most part, stabilizing. And therefore, when it comes to investors, they've looked at how rents have rebased, have lowered, the value has lowered, and so now is a good time for investors to invest in retail. And so we have seen that in Australia in a very significant way. We've also seen the hospitality sector continue to perform really well for the first half of the year. Q2 activity might have been muted a little bit due to really strong activity a year ago, but we're continuing to see that activity take shape, especially with tourism drawn to markets beyond just Japan, but also here in Korea, as well as in Australia.
Well, we were talking at the start about the drag on some sectors due to the uncertainty around the trade environment, but we are anticipating easing from the Fed, other Asian central banks as well. If that easing is delayed for whatever, that lowering and softening of monetary policy, do you expect to see a potential impact on Asia's property markets?
Well, we're certainly expecting a hold for the Fed for the upcoming meeting, but likely everybody's looking at the September the next meeting, where there is likelihood of Jerome Powell pointing to reductions going forward. But what we have seen with Asian central banks is this divergence of activity from the Fed. So we have seen that from the first quarter onwards. The European central banks certainly have seen that trajectory as well. But with or without tariff deals in place, a lot of the export-oriented markets in Asia-Pacific will feel deflationary effects, and therefore the rate reduction cycle should still exist.
All right, Pamela Ambler of JLL there. Thanks so much for joining us. And we're watching out for HSBC earnings. They're due out in a matter of moments. Second quarter earnings, analysts are going to be focused on the impact of tariffs here, and also a fall in interest rates that have been weighing on its core Asia business. Analysts split on this stock, 11 buys, 12 holds, 3 sells. So hold on for those HSBC earnings due any moment. That is it for Insight. Horizons Middle East and Africa coming up next. This is Bloomberg.